It's starting tomorrow. The $8 silver squeeze. Nobody is talking about Dec 27th cash crisis. Tomorrow morning, while you're finishing Christmas leftovers, a 10-day liquidity blackout begins in the silver markets. 145,000 futures contracts are outstanding, but here's the problem. No market makers, no institutional desks, no liquidity providers. Silver just closed at $71.94 per ounce, a 149% gain this year. Industrial buyers need silver every single day. Solar manufacturers require 50 kilograms daily. Electronics companies can't stop their production lines. Medical equipment producers have strict schedules. But the people who normally sell them silver futures, they're gone. December 27th through January 5th, the ghost week begins. When UBS strategists describe this market as unhinged, that's not casual language. That's a strategic warning. Kitco Metals projects $75 per ounce by year end. That's only a $3 move. In normal markets, that takes weeks. In a liquidity vacuum, it could happen in hours. The trap is set, and it springs tomorrow morning. Welcome to Financial Announcement. My name is Marcus Whitfield. I'm a former commodity derivatives analyst who spent 17 years on trading floors in London and New York. Now I live in Geneva, tracking the patterns most people miss, the convergence points where markets break. If you're over 50, you've witnessed market disruptions before. The '87 crash, the 2008 crisis, the 2020 lockdowns. You understand that when institutions go quiet, that's when the real moves happen. Hit that subscribe button like you're locking in a hedged position, because this channel delivers what mainstream media won't tell you until it's too late. Drop a comment and tell me where you're watching from, because this silver squeeze is global. Now, let's examine exactly what happens when 725 million ounces of silver obligations meet a market with no one home. December 27th, 2025, marks a date most traders will remember for years to come. While families across the world unwrap gifts and share meals, a different kind of unwrapping is happening in the commodity markets. Silver, the metal that powers solar panels, electronics, and medical equipment, stands at a precarious moment in financial history. Marcus has been analyzing commodity markets for nearly 2 decades. He remembers when silver traded at $59 per ounce, when it was considered nothing more than gold's cheaper alternative. But what he's witnessing now is fundamentally different. Silver closed on Christmas Day at $71.94 per ounce, representing a staggering 149% gain for the year. This isn't just another bull run. This is a structural shift that most people aren't paying attention to. The real story begins with understanding what happens when a market loses its participants. Every functioning market needs 3 key players: buyers, sellers, and the middlemen who connect them. These middlemen are called market makers, and their job is to ensure that when someone wants to buy silver, there's always someone ready to sell it, and vice versa. They provide what traders call liquidity. But starting tomorrow, these market makers disappear. Investment banks shut down their trading desks for the year-end holidays. Hedge fund managers leave for vacation destinations. The institutional traders who normally handle billions of dollars in daily transactions simply aren't there. This absence creates what industry insiders call the ghost week, a period from December 26th through January 5th, when trading volume can drop by 70% or more. Here's where the mathematics become concerning. There are currently 145,000 silver futures contracts outstanding on the Chicago Mercantile Exchange. Each contract represents 5,000 ounces of silver. That's a total exposure of 725 million ounces, worth approximately $52 billion at current prices. These contracts don't vanish just because traders take vacations. They remain active, they require daily settlement, and they create obligations that someone must fulfill. Consider the perspective of an industrial buyer. A solar panel manufacturing facility in Arizona requires 50 kilograms of silver every single day. Their production line cannot stop. Orders are placed months in advance. Customers are waiting, and employees depend on continuous operations. Under normal circumstances, the procurement team buys futures contracts to lock in prices ahead of time, protecting the company against sudden price spikes. But what happens when the people who normally sell those contracts aren't available? What happens when the bid-ask spread, which normally might be a few cents, suddenly widens to dollars? The procurement officer faces an impossible choice: pay whatever price the thin market demands or halt production and break commitments to customers. This scenario isn't theoretical. Marcus has tracked the open interest data from the CME group since September 2025. The numbers show a steady climb in futures positions, indicating that institutional players have been building significant exposure to silver. When sophisticated money commits this heavily to a position, it signals conviction based on information that retail investors typically don't see. The timing creates additional pressure. December 26th is Boxing Day, meaning markets in London, Hong Kong, and Singapore are closed. Then comes the weekend. December 30th and 31st see skeleton crews at best, with New Year's Eve celebrations shutting down what little activity remains. January 1st brings another global closure for New Year's Day. Realistic liquidity doesn't return until January 2nd at the earliest, possibly January 5th in practice. That's 10 full days of effectively frozen markets. 10 days when industrial demand continues unabated. 10 days when those 145,000 contracts sit like unexploded ordnance in a system designed for smooth, continuous trading. UBS, one of the world's largest commodity trading banks, recently described the late December precious metals rally as unhinged. When an institution of UBS's caliber uses that specific word, it carries weight. Unhinged doesn't mean exciting or surprising. It means detached from normal price discovery mechanisms, operating outside the boundaries of typical market behavior. The question isn't whether silver will move during this ghost week. The question is how violently it moves when industrial buyers meet a market with no sellers, when futures obligations meet insufficient liquidity, when $52 billion in exposure faces a 10-day vacuum. Tomorrow morning, this theoretical crisis becomes operational reality. There's a moment in every market crisis when separate forces, each manageable on its own, collide to create something far more dangerous. March 2026, silver futures contracts became the primary trading vehicle on November 22, 2025. This technical shift, barely noticed by casual observers, set in motion a countdown that reaches zero tomorrow. The contract carries the ticker symbol SIH26. Behind that simple alphanumeric code lies billions of dollars in obligations spread across three distinct groups, each with incompatible goals. Industrial manufacturers need physical silver delivered to their facilities. Speculative traders bet on price movements with no intention of taking delivery. Institutional hedgers balance complex portfolios where silver represents just one piece of a larger strategy. All three groups now find themselves locked in the same contract window, converging precisely when market infrastructure collapses. Robert Chen manages procurement for a semiconductor fabrication plant in Taiwan. His company uses silver in conductive pastes, bonding wires, and thermal management systems. Every wafer that leaves his facility contains trace amounts of silver, multiplied across millions of units annually. Robert's team secured their silver supply 6 months ago through futures contracts, a standard risk management practice. They locked in prices, ensured delivery schedules, and moved on to other concerns. But Robert's counterparty, the entity that sold him those futures contracts, was a market maker in Chicago who never intended to deliver physical silver. The trader planned to offset the position through liquid markets, buying and selling contracts in a continuous flow that generates small profits on volume. The entire mechanism depends on one critical assumption. There will always be another trader willing to take the opposite side. Tomorrow, that assumption fails. The market maker's desk will be empty. The algorithms that normally provide continuous pricing will be switched off. Robert's contracts remain legally binding, but the infrastructure that makes them executable simply won't exist. If his company needs to adjust their position, modify delivery dates, or roll contracts forward, they'll face a market with perhaps 1/10 of its normal capacity. This scenario multiplies across industries. Solar panel manufacturers in Germany face the same calculation. Medical device companies in Massachusetts run the same numbers. Electronics assemblers in South Korea make the same emergency calls to procurement teams. The demand for silver, both physical and paper, doesn't recognize holidays. Production schedules set months ago drive continuous consumption regardless of what date appears on the calendar. Meanwhile, a different group watches these developments with intense interest. Commodity trading advisors, the professional speculators who manage billions in futures markets, have been accumulating silver positions since autumn. Their analysis identified a supply-demand imbalance that traditional metrics weren't capturing. Open interest, climbing to 145,000 contracts, wasn't random noise. It represented informed capital making calculated bets. These traders understand something crucial about thin markets. Price movements that might take weeks under normal conditions can compress into hours when liquidity evaporates. A $3 increase from 72 to 75 bars requires willing sellers at every price point in between. Under normal circumstances, profit takers emerge at $72.50, at $73, at $73.50, providing resistance that slows the advance. But when those profit takers are absent, when the sell orders simply aren't there, price discovery breaks down. The CME Group publishes daily data on trading volume and open interest. Analysts who study these numbers noticed an unusual pattern developing through December. Volume remained elevated even as the holiday period approached. Normally, traders reduce positions heading into year-end, closing out exposures to avoid uncertainty. The fact that positions stayed high, that 145,000 contracts remained outstanding, suggests something different is happening. Kitco Metals, a respected precious metals analysis firm, published a research note projecting silver to reach $75 per ounce by December 31st. Their analysts based this forecast on technical chart patterns, historical resistance levels, and momentum indicators. But technical analysis assumes functioning markets, normal liquidity, standard price discovery mechanisms. None of those assumptions apply during the ghost week. The bid-ask spread tells the real story. Under normal trading conditions, the difference between the highest price a buyer offers and the lowest price a seller accepts might be 3 to 5 cents per ounce. This tight spread indicates healthy liquidity, abundant participants, efficient price discovery. During the ghost week, that spread can widen to 50 cents, $1, even more. Each widening represents lost efficiency, increased cost, diminished market function. What makes this convergence particularly dangerous is its predictability. Everyone involved knows the ghost week is coming. Industrial buyers know it, speculators know it, market makers know it, but knowing about a trap and avoiding it are entirely different challenges. The industrial buyers can't avoid it because their production can't stop. The speculators won't avoid it because volatility creates profit opportunities. The market makers already avoided it by leaving. Tomorrow morning, when Asian markets open, this carefully balanced system faces its first real test. Every market crisis carries echoes of previous disruptions, and those who study financial history learn to recognize the warning signs before crowds notice. Silver's journey to 49 per ounce in April 2011 remains etched in the memory of every commodity trader who lived through it. The metal climbed relentlessly through early 2011, fueled by monetary expansion fears, inflation concerns, and aggressive speculative positioning. Then, in a matter of days, it collapsed back to $35, eventually settling into a multi-year decline that bottomed near $14 in 2016. But what happened in 2011 differs fundamentally from what's unfolding now. The 2011 spike was driven primarily by speculative excess, by retail investors piling into a momentum trade without understanding the underlying fundamentals. The current situation involves something far more structural. Industrial demand for silver has transformed dramatically over 14 years. In 2011, solar panels represented a minor component of silver consumption. Today, photovoltaic manufacturing absorbs over 100 million ounces annually, a figure that continues growing as renewable energy deployment accelerates globally. Margaret Foster runs a precious metals research desk at a London investment bank. She wasn't working in commodities during the 2011 silver spike, but she studied the historical data extensively. What strikes her most about the current environment isn't the price level, it's the composition of market participants. The open interest breakdown shows institutional fingerprints everywhere. Large commercial hedgers, sophisticated trading firms, industrial consumers, all maintaining substantial positions despite elevated prices and known holiday risks. This pattern suggests something Margaret rarely sees in commodity markets: consensus among informed participants that current prices do not reflect future reality. When industrial consumers continue buying futures at $70 per ounce instead of waiting for potential pullbacks, they're signaling that their internal forecasts show even higher prices ahead. These aren't momentum traders chasing charts. These are procurement officers with detailed supply-demand models, production schedules mapped months forward, and careers dependent on securing adequate inventory. The comparison with gold reveals another unusual dynamic. Historically, silver trades at a ratio to gold somewhere between 51 and 81. When gold sits at $2,000 per ounce, silver typically ranges from 25 to 40. But silver's current trading volume approaches 3/4 of gold as institutional activity. A secondary metal commanding that level of sophisticated attention represents a departure from decades of established patterns. December 2018 provides a more relevant parallel than the 2011 silver spike. That month, the U.S. Treasury market, considered the most liquid market in the world, experienced a sudden liquidity crisis. Trading volumes collapsed during the final weeks of the year. Price volatility spiked dramatically. The crisis stemmed from the same fundamental issue now facing silver: too many obligations meeting too few active participants during a seasonal liquidity drought. The Treasury market recovered because the Federal Reserve intervened, providing emergency liquidity to stabilize trading. Silver futures have no such backstop. The CME operates clearinghouses that settle contracts, but it doesn't provide market-making services. If liquidity evaporates, prices simply move until they find levels where buyers and sellers eventually meet, regardless of how violent that journey becomes. James Wu trades agricultural commodities from Singapore, but he's been watching the silver market with growing interest. His experience with rice futures taught him that markets facing supply constraints behave differently than markets driven by financial speculation. When physical inventories tighten, when delivery obligations come due, prices can move in ways that defy technical analysis and historical precedent. The fundamental laws of supply and demand override everything else. Silver inventories monitored by exchanges show adequate physical metal for current delivery demands. But inventory adequacy depends entirely on price. At $50 per ounce, holders willingly sell. At $70 per ounce, some holders still sell. But at what price do the remaining holders refuse to sell at all? At what level do industrial users panic about availability and start bidding aggressively regardless of cost? Those thresholds exist somewhere, and thin markets have a way of discovering them rapidly. The Hunt brothers' attempted silver corner in 1980 still influences how regulators view the silver market. Nelson Bunker Hunt and William Herbert Hunt accumulated massive silver positions, driving prices from $6 per ounce to over $50 in months. When their leveraged empire collapsed, it nearly brought down major financial institutions. Modern position limits and margin requirements were designed specifically to prevent such concentration from recurring. Yet the current situation isn't manipulation, it's confluence. Multiple legitimate forces, industrial demand growth, monetary uncertainty, supply constraints, technical positioning, converging during the worst possible liquidity window. No single entity controls enough of the market to manipulate prices. Instead, the architecture of the market itself creates the conditions for instability. Patricia Alvarez manages a family office investment portfolio in Miami. Her background in derivatives trading makes her cautious about commodity exposure, but recent precious metals strength caught her attention. What concerns her most isn't silver's rise to $72, it's the lack of meaningful corrections along the way. Healthy bull markets climb a wall of worry, pulling back periodically as profit takers exit and new buyers enter at better levels. Silver's 2025 rally showed few such pauses, suggesting either extraordinary conviction among holders or insufficient selling pressure to create normal volatility. Tomorrow, when the ghost week begins, the market discovers which interpretation is correct. Financial markets operate on a principle that most participants take for granted until it vanishes: the assumption that prices reflect consensus between willing buyers and willing sellers. Tomorrow morning, that assumption breaks down in the silver market, and the implications extend far beyond commodity trading desks. David Hartman sits in a corner office in Stuttgart, overseeing supply chain operations for a major automotive electronics manufacturer. His company produces over 2 million sensor units monthly, each containing silver-coated contact points essential for reliable electrical connections. 6 weeks ago, David's procurement team secured futures contracts covering their January and February production needs at an average price of $68 per ounce. The contracts lock in costs, protect profit margins, and allow the finance department to forecast quarterly earnings with confidence. But David received an unusual call yesterday from his futures broker. The conversation carried a tone he'd never heard before, a mixture of professional courtesy and genuine concern. The broker explained that while David's contracts remain legally valid, executing any modifications during the upcoming ghost week might prove challenging. If production schedules change, if delivery dates need adjustment, if unexpected demand requires additional supply, the normal mechanisms for managing these situations simply won't function normally. This puts David in a position no competent supply chain manager wants to face. He can either accept whatever terms the thin market offers, potentially paying premiums that destroy his carefully calculated margins, or he can hold firm and risk production disruptions that cascade through his entire manufacturing operation. Neither choice is acceptable, yet one must be made. The mathematics of compressed volatility favor those who act first. When markets operate with normal liquidity, a buyer seeking 100 contracts might move prices by a few cents. The market absorbs the demand smoothly, other participants step in, equilibrium restores quickly. But when liquidity drops by 70%, that same 100 contract order can move prices by dollars. The first buyer pays the current price, the second buyer pays a higher price. The third buyer faces prices the first two already pushed higher. Sarah Mitchell manages a commodity-focused hedge fund in Chicago with $800 million under management. Her analysis identified the silver setup weeks ago. The combination of rising industrial demand, constrained supply growth, and technical chart patterns breaking multi-year resistance levels suggested significant upside potential. But Sarah's real edge comes from understanding market microstructure, the mechanics of how orders get filled and prices get discovered. She knows that during the ghost week, every order becomes a price-moving event. A purchase that would barely register in normal markets can trigger cascading effects when depth evaporates. Automated trading systems, designed to operate in liquid environments, can malfunction when their assumptions about market structure no longer hold. Stop-loss orders, meant to limit downside risk, can execute at prices far worse than intended when gaps open between available bid levels. The $80 calculation that gives this analysis its urgency isn't arbitrary. Silver currently trades at $72. Kiko's year-end target of $75 represents a $3 move, but additional pressure points exist above that level. Technical analysts identify resistance at $78, a price level that corresponds to inflation-adjusted peaks from previous decades. If $75 breaks during thin trading, the next credible resistance sits $3 higher, creating the potential for an $8 total move from current levels to $80. Under normal market conditions, such a move would take weeks or months. Sellers would emerge at each dollar increment, taking profits and creating natural resistance. But the ghost week removes that natural break on momentum. If industrial buyers panic about availability, if algorithmic systems trigger cascading buy orders, if short sellers face margin calls forcing them to cover positions, the combination can overwhelm what little liquidity remains. Thomas Brennan teaches financial risk management at a university in Boston, but he spent 20 years in institutional trading before moving to academia. His specialty is crisis dynamics, studying how market stress propagates through interconnected systems. What concerns Thomas about the silver situation isn't the potential for price increases, it's the potential for feedback loops. Consider a scenario where silver jumps from 72 to 75 hours in the first hours of thin trading. Long position holders see paper profits but face a decision: sell and realize gains, or hold expecting further increases. Short position holders face margin calls requiring additional capital or forced liquidation. Industrial hedgers watch their input costs rise, triggering emergency procurement meetings. Each decision creates market orders that move prices further in an environment with minimal absorption capacity. These feedback loops can spiral in either direction. A sudden move higher can trigger profit-taking that reverses momentum just as quickly. But during the ghost week, normal market participants who might buy on dips aren't there. The stabilizing forces that typically prevent extreme moves are diminished or absent entirely. For business leaders, particularly those managing companies with direct silver exposure, the strategic question isn't whether to act, it's when to act, and with what urgency. Waiting for clarity means waiting for the ghost week to pass, waiting for normal liquidity to return around January 5th. But by then, prices may have discovered new levels that make previous concerns about $72 silver seem quaint. The professional advisory that accompanies any financial analysis applies with particular force here. This examination represents strategic intelligence, not investment recommendation. Individual circumstances vary dramatically. A solar manufacturer with thin margins faces different calculations than a hedge fund with diversified exposure, but both share a common reality. Tomorrow morning, the rules change. December 27th doesn't bring a stock market crash or a banking crisis. It brings something more subtle and potentially more disruptive. 10 days when a $52 billion market operates without its normal participants, when industrial necessity meets financial speculation in an environment designed for neither. The trap isn't hidden. Every informed participant knows what's coming, but knowing a storm approaches and being adequately prepared are different matters entirely.